Thank you. Hello, everyone. So today I'm going to share some of the recent results we have by analyzing a large data set. So first of all, some background of this research. At Western University, we have a research lab called Financial Wellness Lab. And the lab aims to analyze how financially resilient Canadians are, and whether they are prepared for a financial crisis or whether they are prepared for their retirement. And the advantage of this lab is that we collaborated with a lot of industry partners and in financial industry. And our partners provided us with a lot of data that would be otherwise unavailable to researchers. So we get a lot of insight by analyzing these data. And that is, this project analyzes one of these data sets. The data set is provided by a registered investment builder with clients mostly in Ontario and British Columbia, I believe, or Quebec. And the data set has a lot of information on their investments. We have information on clients. For each client, we know their demographic information, the so-called know your client data. We have things like their age, their gender, where they live, their marital status, their retirement status, things like that. And when this client open an account with the financial institution, they have a talk, they have a discussion with financial advisors, and they decide their risk tolerance. They decide to what amount of risk they want to have in their portfolio. So the investment is classified into 5 different risk levels, from low risk to high risk. We have 5 levels. And the risk tolerance is given by the percentage of investments that the client wants to invest in each category. And finally, we know the accounts this client has with this financial institution. Oh, okay. So for each account, we have a daily snapshot of their position. We know the type of securities they invest in this account. We know the amount of each security, and we also know whether they made any trading decision on this security for each day. For each transaction, we have the date of the transaction, we have the amount of the transaction, and also we have different categories of transactions, because some of the transactions are initiated by the clients, like they make additional deposit or additional contribution to their accounts, and others are more or less automatic, like when they have a dividend or when they have pre-authorized contribution. And when we want to calculate things like rate of return for this client, the categories do matter, because some of the transactions require additional money from the client and others don't. In total, we have over 130 categories for transactions. And finally, for each security, we know the risk level, and we also know their historical price. And here's some, yeah.
The labels are done by your investment partners, or you guys do it yourselves?
The risk level for security. This one?
Yeah.
It's done by the partner. So it's more like.
So they give you label data.
Yes, yes. Okay. So here is some summary of the data set. The data set starts from 2019 to 2022. Which is a very interesting time period, because we have like roughly 8 months of pre-COVID data. And then we have the data for the entire COVID market crash. We have the recovery. And finally, in 2022, we have a high interest rate environment. So the data has a variety of macroeconomic scenarios. This makes this data set very interesting, and we are able to do a lot of analysis using the data set, like analyzing how investors react to markets crash, or how COVID impacts a client's financial wellness. I believe tomorrow at the same time, Professor Messerer will talk about some other projects we have done using the data set, but today I will focus on just one of them. So in total, we have 56,000 clients, and we have 115,000 accounts. On average, each client has 2 or 3 accounts. And in total, we have 31,000 securities in the data set. And here's a breakdown of the account type. The majority of the accounts are RRSP accounts or TFSA accounts. These are like tax-advantaged investment accounts. We also have non-registered accounts like cash. Well, it's called cash, and also we have some retirement funds like REIF. The majority of the accounts are in Canadian dollars, although we have some accounts in US dollars. For this project, I analyze RRSP only because for RRSP accounts, there are a lot of regulations and you can't do whatever you want. For example, although under certain circumstances, you can withdraw from your RRSP account, but generally, if you withdraw, you will have disadvantage in terms of tax. So clients will have like incentive to not withdraw from their accounts. This is one of the assumptions we make in the project. And about the clients, we see that the average age of the client is 61.3 years old. So this is quite close to what is considered a normal retirement age. And also it's worth noting that to open an investment account with this institution, you need to invest at least, I believe, $100,000. So these clients are relatively wealthy Canadians. It would be interesting to have a more representative data set for average Canadians as well. As I mentioned, when they open an account, they determine their desired risk level. So, and the desired risk level is given by the percentage of investment in each risk category. And from their position data, we can also calculate their actual risk level from the securities they invest in and the amount of time they invest in this security. On this plot, on the horizontal axis, I have the prescribed risk. And on the vertical axis, I have observed risk. These values are weighted average of the securities invested in their accounts. The weight is by time and by amount. So if a person invests more money in one security, then the security will have more weight. If this person invests in the security for a longer period of time, the security will also have more weight. And we see that there's a rough linear pattern here, meaning that they are, like, if they do want more risk, they will have more risk. But if we draw a y equals to x line here, we see the majority of the lines are below that line, meaning that in practice, clients and advisors are more careful about their investments, and they usually try to be on the safer side by having slightly lower risk than what they want. Yeah.
The prescribed risk is their actual IPSS and portfolios that they should be involved in, or is it the thing that is measured from behavioral model?
Is their like when they open their account, they say, I want, say, 20% of my investment in low risk, 40 in medium risk, things like that. And the prescribed risk is just like a weighted average of these risk levels. It's not what they actually invest, it's what they want.
Based on questionnaires.
Yes, yes.
They open their account.
Yes, yes. Okay. All right. And also we have a relationship between age and their portfolio risk. We see there's a decreasing trend, meaning that when clients get closer to retirement, they do tend to reduce the risk of their portfolio, which makes sense, right? Like if I'm 64.9 years old, I wouldn't invest everything in, say, cryptocurrency or something like that. I want to have a safer retirement saving. Okay. And here's a summary of the data set. Using this data set, we want to answer these questions. So as a general goal of our lab, we want to evaluate a person's financial wellness. And as a person with a background in actuarial science, I want to study the likelihood that the investors will have sufficient funds for their retirement. Now, if we look at the literature, there's an abundance of excellent research on retirement planning. A lot of this research is on, say, retirement fund decumulation strategy. Like if I have $1 at retirement, how can I withdraw this $1 gradually to achieve maximum utility or to minimize the likelihood that I will run out of money before death? Another type of research is the amount of money that I would need. But this type of research study the retirement spending, like they study the cost associated with disease or long-term care, things like that, and determine what is an appropriate level for retirement. However, very few research focus on how can we achieve these goals. Like if I am a 30-year-old now, and I know the amount of money I will need for my retirement, how can I achieve that goal? I believe with the data, we can analyze what is a good investment strategy so that I have the highest probability of a successful retirement. So to do that, we need at least two components. The first component is a model for financial market return, and the second component is a description of how investors invest. For the financial market components, there are some commonly used stochastic models. We have from the very basic geometric Brownian motion to some jump diffusion models. And in a lot of this research, the parameters of these models are assumed constant over time. But what we observe in the past couple of years is that there are different phases of economy. But if you are a person in finance, you should be very familiar with these two graphs. The orange line is the Toronto Stock Index, and the blue one is the VIX Index. Although the VIX Index is for the US market, but these two markets are highly correlated and is also a very good indicator for Canadian volatility. And we see that before the COVID crash, the volatility is relatively high and the return, the index is relatively high. And all of a sudden, the index dropped and the volatility went up. And gradually they fall back to the original level. So what I can read from this plot is that there are different phases of economy, and for any long-term modeling, especially for retirement planning, we are talking about like 30 years, 35 years. It is crucial to include those changes in market. So a natural choice is a hidden Markov model. A hidden Markov model uses a Markov chain to describe market conditions, and condition on each market, we know how the security evolves. In the literature, there are already some study using hidden Markov model on financial markets. The first one is from the Financial Stability Review, published in 2018 by European Central Bank. In this study, they analyzed the weekly return of Standard & Poor's 500 index from 1928 to 2018. And they applied a regime-switching autoregressive conditional heteroskedasticity model proposed in Hamilton 1994. And this is their results. On horizontal axis, we have time, and on vertical axis, we have the probability of each state. The green one is low volatility, the yellow is medium volatility, and red is high volatility. For example, here, after 2008 market crash, the volatility is high. And yeah, the study ends at 2018, but if we continue the plot to say 2023, we will also have high volatility for 2020 as well. Another very interesting research is by Goods 2017. I think this research is the most relevant to what we are doing because this one analyzes the volatility directly. So they also study the S&P 500 index, but this time they use a regime switching Heston model. The evolution of S&P 500 index is assumed to have the Heston model, but for the volatility, it is assumed to be a regime switching CIR model. Okay, so the interesting part is the Markov switching CIR model here, but we do have some challenges because usually when you have a hidden Markov model and you want to estimate the parameters from data, you have something that is observable and unobservable. Like for example, in this example, the observable variables is the value of Standard & Poor's 500 index, and the unobservable is the hidden volatility state. But in this paper, if we want to analyze the volatility is not directly observable. Okay, like if we only consider the second line and the third line, none of these variables are observable directly. So what the author did is they used the VIX index, which is implied volatility based on options written on S&P 500. They used the relationship between VIX index and volatility, and they developed a parameter estimation procedure for the hidden Markov model. And the result is given here. So this time, this is 2000, and the end is 2015. And we see very similar results. We have high volatility, medium volatility, and low volatility. And of course, there's always a simpler alternative, which is Markov switching dynamic regression model. So basically, it's a regression model, but we allow the parameters to vary with the hidden states. And this method is well established. And if we apply this to weekly index return, we have this plot. And again, the y-axis is probability, and we see when when there's a market crash, it's likely to be in high volatility, and that's the most likely states, and for Standard & Poor's 500 index. So all three models give us very similar results. So although the second one is the most elegant in my opinion, but it is difficult to apply to real data because that requires us to calculate the calculate the likelihood function, which is a very complex function. On my laptop, which I bought last year, evaluating the likelihood function with one set of parameter takes like around 10 minutes. So it's kind of difficult to apply that method to new data. So in this project, we simply use the simplest one, the Markov regression model, and use the estimated parameter for simulation. Questions? Yeah, okay. Okay. Now we have the hidden state. So basically we estimate the hidden states based on Standard & Poor's 500 index. And we assume that these states are macroeconomic factors that have impact on all securities. And condition on the hidden states, which can be low, medium, or high, we simply use a geometric Brownian motion for security price. Now, we use only one hidden state for all securities. That way, we have some dependency among our securities. Okay, I will talk about that later. Ooh. And here is the estimated parameters. This is the transition probability matrix, and here is condition on the hidden states. What is the parameter for the GBM? Okay, and in this plot, the blue dots are for low volatility. We see that we have positive drift and a relatively low volatility. The light blue one is medium volatility, and this time we also have positive drift, but higher volatility. The yellow dots are parameters for high volatility state, but this time we have negative drift and very high volatility. And if we go back to this plot, we see that these high volatility states usually happen during a market crash. Okay, so for the three states, low volatility, medium volatility, these two states are likely for normal times, and for high volatility, it is likely some market crash or major market downturn. Okay, and if we simulate a sample path for all securities and we calculate the average price on each day, essentially we have a sort of hypothetical index on this market. And we see that this model can have features like market downturn compared to some other models. And as I said, I use the common hidden states for all securities. That way we have dependencies. If we have one hidden state for each security, then we don't have the dependency and the index does not have market crash anymore. Okay. In a previous version of this work, I also used a jump diffusion model. So compared to jump diffusion model, the regime switching GBMs have more gradual market crash rather than a sudden drop. I ran the simulation with both models, and the results are quite similar, although the exact numbers are different, but the general pattern are the same. So we use this regime switching GBM for simulation. Okay. And the second part is investment behavior. This is a tricky part because behavior is a very broad term, and it can include many different aspects. Our plan is to run a clustering analysis on the data set and see what type of investment behaviors these clients have. This is a previous work on a smaller data set. They use a modified behavioral finance recency frequency monetary model for feature engineering. And the features they use are first demographic information. They also have information on how frequent the investors trade and by what amount do they trade. And they have 5 clusters. We see that clients in different clusters do have different behaviors. Some trade more frequently and some trade less frequently. This result is very useful for us to understand the structure of the data. But for simulation, we will need some more detailed description of how they rebalance, how they choose their portfolio.
These non-discretionary accounts then
yeah, these are
trading or telling the advisor what trade or
these are non-discretionary accounts, and the trading decision, the majority of the trading decision comes from the advisor, although clients do sometimes initiate trades on their own. Yeah. Okay. And the existing literature, there are some work on investment behavior, but this work focuses on very detailed aspects, a detailed small aspect of behavior. For example, how they trade before a public holiday, things like that. Okay, and if we analyze the number of accounts with transactions for each day on these plots, the shaded area is the COVID market crash. We see that a lot more clients decide to rebalance their account during a market crash. So that means at least some investors react to a sudden market movement. And when they trade, they also change their their portfolio risk. If we calculate the change in portfolio risk, we see that the majority slightly change the risk level only slightly, and very few people, very few clients changed their risk significantly.
Sorry, the previous slide. Do we know how many of those are just trades, right?
These are number of accounts.
With the transaction.
Yeah,
we don't necessarily know if it was like a net sort of buy or sell.
No. These are the number of clients who had at least one transaction on each day. Yeah.
Okay.
Yeah. And then this plot is what they did. Transaction. This is a very good question because we only count for those transactions that require active trading. So we don't include things like dividend or pre-authorized contribution. We only account for things like withdraw, rebalance. I sell something, buy something else, things like that.
So if you have that adjustment at different periods, or because it's over the entire period, right?
Yeah.
I think question. Yeah. So did you try to segregate that because whether that was like, for example, that trade on trade was at the risk? I would have guessed that would have been a heavy risk kind of trade versus something there or not.
I'm not sure. Can you repeat your question?
Yeah. So for example, the period of very heavy trading.
Yeah.
You have the delta that period.
Oh, this delta is only like from here to here.
Oh.
Yeah. It's not from here to here. Yeah.
Oh, and that was not very high change of risk.
No.
Element 5, I read that correctly. In fact, somebody did the right thing. They actually bought more equities.
Yeah.
Is that right? Because they didn't change the risk level, so it stayed constant. They would bought more equities.
Yeah. Yeah.
Yes, that's amazing.
There's a lot of expected and all.
Yeah,
No, I don't even know how you're seeing that.
Because the risk level is the same, right? So they didn't have a constant weight for it, right?
But if they're decreasing their risk by, between 0 and 0.25, then
Well,
they're-
but most of them are roughly zero change, right? That's your, if I read those numbers, right? You made some statement here, and I could look at, you said, and most of the clients kept their risk level the same.
basically.
yes, yes. So in each risk level, we have many different securities, and they may sell something in this risk level and buy something else.
On stocks, that five, they bought more equity.
Yeah, absolutely balanced. to get the-
Right,
Yeah, yes.
which is surprising.
Or maybe they're getting good advice,
Yeah.
right?
Yeah.
Like, yeah.
But I did not expect.
I'm not sure I'm allowed to disclose the name of the partner, but it's
And
Yeah.
But do you have the delta for like the regular plan as well? Like how?
like from here to here.
Yeah, like.
Here's the difference.
I don't have it now, but it would be it would be like yeah, because during regular time people adjust. I don't have it in the slides, but if we analyze a couple of the sample like change of risk level, we see that the risk level goes up and down for one client. So they increase their risk, they decrease their risk. So I guess depending on the time period you're looking at, it can go either way. It can be increasing the risk or decreasing the risk. Yeah, move all the time, but when it's not a crash. Yeah.
these guys are all being advised.
Yes.
They are this,
So,
Actually, can I ask, actually, majority delta has decreased, it means that they sold the stocks, right?
Yes.
So it means that they did the wrong thing. They're supposed to buy when market went down, so they're losing and doing
that's a small
smaller
amount,
job.
but it's very little, a small amount. right?
A small amount, but majority is still, keep selling stocks when they should buy.
So 0.25 is very little.
Yeah.
Right?
I'd say that's
Uh,
approximately zero.
Yeah.
We have 90% between minus 1.5 and 0.25.
Yeah.
Right, something like that, which means they maintain their risk more or less. Maybe a little bit less, but not.
It didn't panic.
Right.
So, does this, do these accounts still correspond to the wealthy investors like you had said, who are to deposit, had to trade a minimum of 100,000? You had mentioned before.
Yeah, they have like an entry requirement to open accounts, and each of this client has a financial advisor.
Sure.
And
I think somebody mentioned it already, but for instance, if we're thinking about risk as, maybe this is not what you're doing as sort of a ratio between, say, stocks and bonds, and during a market crash, the value of, say, stocks goes down by more, then their risk should naturally go up if they're not rebalancing. So the fact
Yes,
that they're-
yes.
the fact that risk is not going up.
Meaning they are actively rebalancing their
means they're
portfolios.
actively rebalancing. So they are doing.
But these are risk weights, right, for security, it's based on risk weighting. for
Yes,
security.
yes.
It doesn't, but you don't check.
Uh,
So the only thing that changes are the weight.
Uh,
weighted average.
the weight is by the amount and the time. If one security goes up in price, it will naturally have more weight.
But its risk level doesn't change.
A risk level doesn't change.
So you see that the securities don't change their risk for each security, it's just it's not like a one risk model, it's just a weighted average. That's what they do of some risk number per security, and that doesn't change. They have a stock, and the stock is high risk, maybe like 4, and the share says 4. You don't change the thing that changes the weight from there, right? That's
Yeah,
the way
yes.
it's stored.
So how we proceed with this project is we do need a more detailed description of their trading decision, their trading strategy. And because we are using a hidden Markov model with 3 states, with first 2 states being normal times and the last state being crash time, it is natural to assume they behave differently during normal times and crash times. So here are the strategies I use for normal times. I assume some clients are reactive to market movements. Like they look at their phone all the time, and if their security is underperforming compared to some other securities, they would immediately sell it and buy the best performing ones. The trading time of this type of client is dependent on market movements, dependent on the path of the index. The second type of strategy is systematic. This type of clients rebalance their portfolio maybe once a year, maybe once every 6 months. And when they rebalance, they choose the best performing security within each risk rating. And finally, we also observed some clients who never trade. So these are inactive clients. When we have a high volatility state, when we have a market crash, some people panicked. Although in our data set, there are not a lot of such clients, but we do observe some clients who panicked and sold everything during a market crash. The majority of the clients in our data set adjust their portfolios based on what they think is the best strategy. And some clients do nothing. Okay, and we also combine the saving components to these strategies. So in total, we have 14 different combinations of how they react in normal times, how they react in crash time, and whether they save or not. Yeah. Oh, A1 plus is like our clients who are reactive to market movements, but who panicked during a crash and who is a systematic saver. Yeah. So in total, we have 14. So using the using the regime switching GBM framework and these strategies, I run a simulation study with 100,000 sample paths. And these are the results of their internal rate of return, because some of the clients are actively contributing to portfolio and others are not. So it's not fair to just compare their retirement wealth. A more reasonable measure is internal rate of return. So we see that for clients in group A, these are clients who are reactive to market movements and who trade a lot. Their internal rate of return is lower than group B for people who trade systematically, periodically. And within each category, we have the best performing is during a crash is strategy 2. These are the clients who rebalance their portfolio during a crash. And the worst is panicking. Because what we observe in reality and in simulation is that after a market crash, there's usually a recovery phase. If you panic and you sell everything, that means you lose money and you lose the opportunity to recover. So naturally, if you panic, you will have the worst outcome. And what's also interesting is the clients with savings usually achieve higher rate of return than clients who did not save. Okay, and I run some sensitivity analysis, and apparently the outcome of C3, which are clients who never trade, depends on their initial portfolio. But no matter what the initial portfolio is, the clients with saving usually outperform clients who did not save. And yes, it's sort of like a monthly contribution or annual, other than the principal. Yes. Okay.
So is that why we have this about 70 basis points right there? Is that right? From the left to right?
These are like 8% per year, 8.7%. Yes, 9.2.
So what are the fees?
Yeah, exactly. So in this simulation study, I assume that there's no transaction fee. But if we count transaction fee, then people who trade more frequently will be worse.
Advice?
Yes.
I mean advice fee?
Oh, advice fee.
Yeah, no.
It's not, the advice fee is not considered, but because it is the same for all of these clients. But yeah.
What about the group? On that is really well.
Here, basically it means the best strategy is like you rebalance your portfolio systematically, and you rebalance your portfolio during a crash, and you are a systematic saver. Okay. So based on these studies, I have 3 conclusions. So panic selling could be detrimental to your outcome. It is difficult to beat the market by trying to trade more frequently, and consistent saving is important for achieving retirement goal. Now, this is what the simulation tells us. What does the data tells us? This is from another project at our lab. In this project, we analyze the portfolio value, the evolution of portfolio value. We run a clustering analysis using dynamic time warping as a distance measure. So basically, dynamic time warping is measure the similarities of 2 time series, but with different speed. For example, it is often used in speech recognition because different people may have different speed of speech, and the information contained in this sentence is the same as the information contained in this sentence. So dynamic time warping measures the similarity, but ignores the speed. In financial setting, imagine one person trade every year, another person trade maybe every 6 months. So they are both systematic traders, but they have different frequencies. And using dynamic time warping, we will group these 2 people together. And analyzing the market value of these clients, we have 3 distinct clusters. Cluster 2 did really well. Their wealth grew to over 1.2, grew by over 20% during these 1.5 years. And cluster 3 did really poor, and their value decreased by roughly 30% during this. Sorry.
What would be the growth characteristic of each cluster?
Okay. Yeah. So if we look at why they have these changes, we see that cluster 3 withdraw a lot of money during the market crash, while cluster 2 actually continue contributing to their portfolio during the crash. So cluster 3 are clients who panicked and withdrew from the market, and cluster 2 are clients who continued doing what they did before market crash. Yeah. So for each cluster, for each cluster, they have different preference for portfolio. They have different preference for securities. And this is like the typical portfolio in that cluster. So basically that says cluster 1 has a slightly worse portfolio than cluster 2, but cluster 3 are the worst, like they choose a really bad portfolio to begin with. But what is interesting is the last one, attributed, the total growth attributed to trading friction. So basically this is their trading decision. And we see that cluster 3 has a -3% compared to cluster 2 with 5%. So again, this study is, the conclusions from this study is consistent with my simulation study. And we can, yeah. What I'm saying is difficult to beat the market by trading more. Maybe like if you have more information that others don't know, trading more can be beneficial, but for an average trader, it can be quite difficult to beat the market. Okay, so basically that is this project. Of course, this project can be expanded in many directions. We can have more accurate description of investment strategy, and we can consider other components like gliding path or after retirement decumulation. But for now, that's all I have. Thank you very much. If you have any questions.
Thank you.